Here again with smart system. In our last lesson, we looked at how an individual's need to be part of a group with a strong leader can be detrimental to one's trading success. In today's lesson, we're gonna switch gears away from the psychology of trading with a look at how to set realistic profit expectations. The first step to building a successful money management strategy. The key component to any successful trading strategy is setting realistic profit expectations. All too often, I see traders with account balances of $10,000 or less who are expecting to make a living off of their trading profits within a very short period of time. Now, while this is not surprising, considering all of the hype that's out there, associated with most trading, education and signal services, etc. that are out there, it unfortunately does not make that a realistic goal, as most successful traders will tell you. The US stock market, which has been the best performing asset class over the last 100 years, has averaged about 10% a year over that time period. So what this means that, if you would have invested in 30 stocks that make up the Dow Jones Industrial Average, over the last 100 years, you would have averaged about 10%, and you would have beaten any other asset class that you could have invested, on average over that time period. What those same traders will also tell you is, with that in mind, if you can double that return as a trader, you're gonna be considered among the top traders out there. So does this mean that if you're new to trading, with a small account balance, that you can't eventually earn a living, or even become rich from trading? No, it does not. But what it does mean is that your expectations need to be in line with reality, so you can develop a long-term plan that will lead to success. Instead of following the path of most small traders, who swing for the fences on every trade, and eventually blow their account up. Let's look at a couple scenarios. What most successful traders will also tell you is that, as a small trader, you have much more flexibility regarding what you can put money into as your small trade size, and is an advantage, in the sense that you don't move the market or catch the attention of other traders. You may try and profit off of what you're doing, at your expense. With this in mind, I think most successful traders wouldn't argue with 30% as a reasonable target for profits for the year. While you're small now, assuming you left your profits in your trading account at the end of each year, so that you could compound your returns and average 30% a year, obviously, with some years being better and some years being worse. Your returns on an account balance of $10,000 or an initial account balance of $10,000 over 20 years would look like the following now, depending on where you live and what your financial requirements to live are. You may be satisfied with this. If you are not, however, does this mean that you're doomed to never live your dream of being a professional trader? No, it does not. If you can produce those types of returns consistently, what most successful traders are also going to tell you is that there's going to be people lined up at your door to offer you money to trade, as you're going to be beating the markets, handling most years, and you wouldn't have to produce these types of returns for more than a couple of years in a row before that would happen. And you could raise, even in the several millions of dollars, type of money to trade. So most successful money managers charge a management and performance fee, which is somewhere in the neighborhood of 2 and 20, which is 2% of assets under management yearly, and 20% of net new profits, as their compensation for managing other people's money. With this in mind, if you're able to produce a track record, similar to the one we just listed, for 2 to 3 years running, and then we're able to raise $5 million, which shouldn't be that hard considering you know the type of returns you've just generated, then your yearly management fee would look, and your compensation scheme would look like the following. Your 5 million times your 30% profit will be 1.5 million in profit for the fund, 2% management fee. So 2% of the 5 million would be 100,000. 20% of the 1.5 million would be 300,000. So your total compensation for the year, there would be 450,000. So if you think about it, it's a much more intelligent way to become a successful and very profitable trader, where you can make a very good living and actually become rich trading, if you have a small account, is to develop a profitable track record by not swinging for the fences, but by practicing sound money management principles and developing a good track record that people want to put money behind, and then raising money. And you're going to be able to make a substantial amount more, most likely, than you're going to make swing for the fences, where you're most likely going to blow your accounts up. So that's our lesson for today. And next lesson, we're gonna look at several different ways of protecting one's capital while trading. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. Have a great day.